the Architect of Wisdom, Lessons from the Life and Times of Charlie Munger. Act 1, The Foundation, A Boy from Omaha. Well, let's get started. I want to talk about one of the most remarkable and underappreciated stories in the world of business and investing. It's a story that doesn't get nearly enough attention, and it's a story that holds the key to understanding one of the most successful partnerships in history. This is the story of Charlie Munger. Now, when most people think about legendary investors, they might picture a loud, fast-talking trader on a Wall Street floor. Charlie Munger is the absolute opposite of that. He's a man who built his fortune not through frantic buying and selling, but through immense patience, rigorous intellect, and a deep understanding of how the world really works. His journey from humble beginnings to becoming one of the most respected investors ever is a masterclass in clear thinking and character. To understand the power of Charlie Munger's approach, you have to start at the very beginning. He wasn't born into great wealth. He came of age in Omaha, Nebraska during the Great Depression. That experience of seeing hardship up close imprints a certain kind of financial prudence on a person. It teaches you that capital is hard to accumulate and terrifyingly easy to lose. He didn't just hear about it, he lived it. That fundamental reality, that respect for the fragility of capital, became a cornerstone of his philosophy. You can't teach that kind of fear in a business school. It has to be lived. He worked in the grocery store owned by his grandfather. Now, let me tell you, there are few better places to learn the fundamental realities of business than a grocery store. It's a perfect microcosm of capitalism. You see the importance of turnover. You can't have produce sitting on the shelf going bad. You learn about tight margins. A penny saved on a can of beans is a penny earned for the family. You understand customer service and the value of honest dealing. People won't come back if you short-weight them or sell them rotten fruit. That early, hands-on experience with the bedrock of commerce was a formative education. It was better than an MBA. It was real. His path wasn't a straight line. He was a bright young man with a scientific mind, and he went to the University of Michigan to study mathematics. But like so many in his generation, his education was interrupted by the great upheaval of World War II. He enlisted in the Army. Now the Army, in its infinite wisdom, decided to send him to Caltech to study meteorology, of all things. He never saw combat, but he learned a different kind of lesson: how to work within a large, complex, and often illogical system. Figuring out how to navigate that kind of bureaucracy, how to get things done within a rigid structure, is a mental model that comes in very handy later when you're analyzing massive corporations or dealing with government regulation. It teaches you about systems and incentives in a very practical way. After the war, he pulled off a classic Munger move. With no undergraduate degree, he used his sheer intellect and force of personality to talk his way into Harvard Law School. He didn't just get in, he excelled, graduating magna cum laude. He moved to Southern California and built a very successful law practice. He was on a path to a comfortable, respected, and predictable life. He had achieved what most people would consider the pinnacle of success. But Charlie's mind was never meant to be confined to just one discipline. He understood something fundamental about the world that many professionals miss. He saw that while law provided a good living, it was ultimately a profession of trading hours for dollars. There was a ceiling. His ambitions, his mental models were geared toward owning assets, not just renting out his time. He wanted a fortune, not just a high salary. He wanted to be in a position where his money was working for him, not the other way around. And he was willing to be patient, to learn, and to build that fortune brick by brick. This decision to move from a high-status profession to the uncertain world of investing and business building took immense self-confidence and a long-term vision. Act 2, The Apprenticeship of an Investor, Building the Lattice Work. This is where the real education of Charlie Munger, the investor, began. In those early years, he didn't have much capital. So what did he do? He did what all wise people do. When their resources are limited, he was patient. He practiced what he later, with his characteristic wit, called sit on your ass investing. He would live well below his means, saving every dollar he could from his law practice, and he would wait. He wouldn't make a move for months, sometimes years. He understood that activity, for the sake of activity, was the enemy of the small investor. But he wasn't idle. He was building his intellectual capital. He read voraciously. Not just finance, but history, psychology, biology, physics. He was constructing what he would later famously call his latticework of mental models. The idea behind the latticework is brilliantly simple, yet almost no one does it. You need to have the big ideas from all the major disciplines in your head. You've got to have models from physics, like the concept of equilibrium and critical mass. You need models from biology, like evolution and competitive exclusion. You need models from psychology about how people think, and from history about how societies and economies cycle. You then array your experiences, both your own and those you read about, onto this latticework. If you only have a hammer from your one discipline, you see every problem as a nail. But if you have a full toolkit, you can approach a problem with the right wrench, the right screwdriver, or the right measuring tape. He understood that the key to great investing wasn't being a master of one tiny field, but being rationally competent in 100 different models of how the world works. This latticework became his supreme advantage, allowing him to see connections and risks that others missed entirely. When he did invest, after all this reading and thinking, he didn't dabble. When a truly compelling opportunity presented itself, one he understood completely, that was within his circle of competence, and that was priced absurdly low, he would bet big. He would commit a significant portion of his capital. He might only make 3 or 4 of these investments in an entire decade. But when he swung for the fences. This requires a temperament that is very rare. Most people feel the need to be doing something all the time. Charlie felt the need to be right. His early investments weren't just in stocks. He invested in real estate development projects and even took an active role in his own law firm. He wasn't just a passive buyer of tickets. He was a builder of businesses. He would roll up his sleeves and help improve the operations, the strategy, the very essence of the enterprises he owned. This hands-on experience gave him a gut-level understanding of what makes a business truly valuable: its mode, the quality of its management, its fundamental economics, that you simply cannot get from reading a financial statement alone. He was learning business from the ground up. This leads to the first great Munger lesson, one he borrowed from the great mathematician Carl Jacobi: invert, always invert. Charlie loves to invert a problem. Don't ask how you can get rich. Ask how you can end up poor. How do you stay poor? It's simple. Be impatient. Trade constantly. Follow the crowd. Buy whatever is hot and exciting. Use leverage so that a small market drop can wipe you out. Believe you are smart enough to predict the short-term gyrations of the market. Focus on what the stock might do next week, not what the business will be worth in 10 years. By clearly understanding and systematically avoiding what causes failure, you naturally pave the way for success. The goal is not to be brilliantly right on a complex trade, but to be consistently not stupid over a long period of time. It's a less glamorous path, but a far more profitable one. Act 3, the partnership, the architect of a better philosophy. Our paths crossed in 1959 in Omaha. I was back running a small investment partnership, and Charlie was in town for a visit. A mutual friend, Dr. Edwin Davis, insisted we have dinner. He told me, "You need to meet Charlie Munger." From the moment we started talking, it was obvious this was no ordinary mind. He was sharp, witty, decisive, and had a way of cutting through nonsense that I found incredibly refreshing. We didn't talk about specific stocks much that first night. We talked about business in general, about life, about human psychology, about history. It was like finding an intellectual twin. The conversation just flowed. We started collaborating, and our philosophies began to merge and strengthen each other. In those early days, my approach was still heavily influenced by the classic Ben Graham approach. I was what you'd call a cigar butt investor. You'd find a company that was so statistically cheap you could buy it for less than its net working capital. It might be a terrible business in a dying industry, but it was like a discarded cigar butt with one free puff left in it. You take that puff, that one last distribution or liquidation, and then move on to the next one. It worked, and it was a perfectly sound method, but it was a small-scale, labor-intensive game. You were constantly looking for a new cigar butt. Charlie saw the limitations of this better than I did. He pushed me, gently but firmly, toward a better way of thinking. He would say, "I have long believed that a certain system, which almost any intelligent person can learn, works way better than the systems of most people. What you need is a lattice work of models. You've got to have models in your head, and you've got to array your experience, both vicarious and direct, on this lattice work of models." But his most direct and impactful advice, the one that truly changed the trajectory of everything, was this: "Warren, forget about ever buying a mediocre company at a fair price. It is far better to buy a wonderful business at a fair price." This was a revolutionary idea for me. It shifted the entire focus from pure statistical cheapness to the quality of the business itself. Why was this so powerful? Because a wonderful business compounds in value over time. It has what we came to call a moat, a durable competitive advantage that protects it from competitors, like a powerful brand like Coca-Cola. A geographic monopoly like See's Candies was in its early days, or a network effect. A wonderful business can often withstand poor management, a bad economy, or other shocks. A cigar butt has no moat. It's just a one-time statistical anomaly. Once you take that puff, it's gone. Charlie was the architect of this philosophy. He understood that by owning a collection of these wonderful businesses, you were essentially buying a machine that would create more and more value for you year after year, through good markets and bad. You could sit back and let the power of compounding do the heavy lifting. You were no longer a scavenger, you were a builder. This was the genesis of the entire modern Berkshire Hathaway approach. He moved us from buying okay businesses at great prices to buying great businesses at good prices. It seems like a small shift in wording, but it made all the difference in the world. It moved us from an arithmetic game to a geometric one. It was the difference between collecting bottle caps and owning the bottling plant. Act 4, the psychology of human misjudgment, the master key. But Charlie's contribution goes far beyond just a better way to value a company. His most profound insight, the one that truly separates him from almost every other investor who has ever lived, is his deep and systematic understanding of human psychology. He realized that the biggest risks in investing and in business aren't in the financial statements or the economic forecasts. They're in your own head and in the heads of the people you're dealing with. He didn't just have a vague notion of this. He systematically studied it. He read psychology textbooks, studied case histories, and observed the world around him. He then codified his findings into what he calls his psychology of human misjudgment. It's a list of about 24 common, hardwired cognitive biases that trip us all up. Understanding these isn't just an academic exercise. It's a tool for survival and success. Let me give you a few of the big ones. First and foremost, there's incentive cause bias. Never, ever, ever underestimate the power of incentives. Charlie says it over and over. Show me the incentive and I will show you the outcome. If you want to understand why someone is behaving a certain way, first look at how they are incentivized. It is the most powerful force in the world of business. A salesperson on commission will sell what pays the highest commission, not necessarily what's best for the customer. A manager whose bonus is tied to short-term earnings might cut crucial research and development to make the numbers. If you don't understand the incentives, you don't understand the behavior. Then there's the Lollapalooza effect. This is Charlie's term for when several of these psychological biases act in the same direction at once, creating an extreme, often irrational outcome. Think of a bubble like the dot-com mania or the housing crisis. You add social proof, everyone else is doing it, so it must be right. You have envy seeing people you know get rich overnight. You have doubt avoidance tendency, the fear of being left out, which pushes you to act without proper thought. You have authority, misinfluence, listening to famous investors or CEOs who are also caught up in the mania. Combined, these forces create a psychological tidal wave of irrational behavior that can sweep even very smart people off their feet. Recognizing the Lollapalooza effect is the first step to avoiding its pull. Another crucial one is the man with a hammer tendency. It comes from the old saying, to the man with only a hammer, every problem looks like a nail. This is the profound danger of a one-discipline approach. If you're only trained in finance, you'll try to solve every business problem with a financial lever. If you're only trained in engineering, you'll see every problem as an engineering problem. You'll miss the marketing angle, the psychological angle, the historical precedent. This is why his lattice work of mental models is so vital. It gives you multiple tools so you can see the problem for what it really is, in its full complexity, and apply the right solution. By understanding these psychological tendencies, Charlie wasn't just trying to understand other people. He was primarily building a system to avoid his own stupidity. He knew that the most dangerous person in the room was often himself, because his own brain, with its hardwired biases, could trick him into making a terrible decision. So he created mental checklists and routines. Before making a big decision, he would run it through his checklist of biases. Was he being influenced by an incentive? Was a Lollapalooza effect at play? Was he viewing this with just one tool from his toolkit? This systematic approach to avoiding error is the mark of a truly wise person. It's not about being smarter than everyone else. It's about making fewer dumb mistakes than everyone else. Act 5, the legacy. A life of principle and perspective. So, what is the final lesson from Charlie Munger's journey? From a boy in an Omaha grocery store to an investing legend. It's that true, durable success isn't built on a single stock pick or a complex financial formula. It's built on character. It's built on a multidisciplinary understanding of the world. And it's built on a handful of simple, powerful principles applied with unwavering consistency over a very long time. He lived a life of rigorous integrity. He believed in the old-fashioned way that your word was your bond. He was famously blunt and brutally honest, not to be cruel, but because he knew that clear thinking requires clear speaking. You can't solve a problem if you're not willing to call it what it is. He didn't suffer fools gladly, but he was endlessly generous with his wisdom and his time to those who were genuinely willing to listen and learn. He understood that trust is the most valuable asset you can ever build, and that it can be lost in an instant through a single act of dishonesty or sharp practice. In the long run, the market for reputation is just as efficient as the stock market. He understood the power of patience and intense focus. He didn't need to be active in 100 things. In fact, he believed that extreme specialization was the key to success. He often said that Berkshire's monumental success came not from a flurry of activity, but from a few moments of intense inactivity, waiting calmly for the right pitch. He calls it the sit-on-your-ass approach for a reason. You work incredibly hard to build your knowledge in your lattice work of models, and then you have the supreme discipline to do nothing, to wait for the rare, no-brainer opportunity that is so obvious it practically hits you in the face. In a world that glorifies busyness and constant connectivity, he was a champion of the power of thoughtful, patient inaction. And perhaps most importantly, he never, ever stopped being a learning machine. Well into his 90s, he could be found with a book in his hand, his mind curious about the world, constantly adding new slats to his lattice work of models. He proved, through his own example, that the most powerful compound interest of all is the interest you earn on your own knowledge. An investment in your mind pays the very best dividends. He read biographies, scientific journals, and history books. He believed that if you couldn't explain something simply, you didn't understand it well enough. This lifelong commitment to learning wasn't a chore for him. It was the greatest source of joy and the foundation of his success. His story isn't just about getting rich. It's about getting wise. It's about building a robust framework for making good decisions, not just in finance, but in every aspect of life. He showed that by inverting problems to avoid stupidity, by understanding your own psychological weaknesses, by valuing character and integrity above all else, and by committing to a lifetime of relentless learning, you can navigate a complex and noisy world with clarity, purpose, and profound success. The Munger philosophy, in the end, is a recipe for a life well lived. It's about being reliable, being rational, and always taking the long-term view in a world obsessed with the short term. It's a philosophy that argues convincingly that the best investment you can ever make is an investment in yourself. And that, I believe, is a legacy worth studying, worth understanding, and worth emulating for a very, very long time. Thank you.